Most investors lose money in mutual funds not because the funds are bad, but because of their own behavior. Even the best funds can't save you if your emotions take over your decisions. So, in today's video, let's talk about 5 behavioral biases every mutual fund investor should avoid. Because mastering these can literally add lakhs to your wealth over time, which will help you meet your milestones faster. The first, confirmation bias. You've decided that doing a SIP in a small cap fund is the best idea ever. Now, every article you read, every YouTube video that you watch, you only notice the ones saying small cap will double every 3 years. You ignore anything that says risk, volatility, or correction. Before investing, make it a habit to ask, what could go wrong? Listen to opinions that can challenge your view. In mutual funds, balance beats bias always. Next, loss aversion. Let's say your equity SIP is down 10%. What's your first instinct? Let's stop the SIP till the markets recover, is what you think. That's your brain trying to avoid pain. But the truth is, you're buying more units at cheaper prices. That's how SIPs work. So what's the fix? Remember that volatility is not loss. It's a feature, not a bug. If your goals are long-term, don't let your short-term fear derail your compounding. The third point is herd mentality. We've all been there. Bro, this new NFO gave me 25% last year and suddenly everyone in the office is switching their funds. That's herd mentality. You start chasing what's popular instead of what fits your goals and risk appetite. So what's the fix? Stick to your plan. Just because an NFO or a thematic fund is trending doesn't mean that it suits your portfolio. The best fund for you is the one aligned with your financial journey, not your friends. The fourth is recency bias. I consider this to be the most important bias that one should be aware of. When markets fall, investors panic. When markets rise, they get really excited and become overconfident. If equity has done well recently, people invest in equity. Currently, gold is doing well and people are always talking about wanting to invest more in gold. If small caps fall, they stop investing altogether. So, don't judge performance by the last 6 months. Mutual funds should be judged across market cycles. Stick to asset allocation. That's what protects and grows wealth. The last is overconfidence bias. Let's be honest. Most of us get really overconfident when the market is doing extremely well. We start crediting ourselves after a few good years of returns. They start saying stuff like, I know which fund will outperform next. They switch funds too often trying to time the market and end up losing more to short-term exits than to bad funds. The fix is very clear. Have confidence in your process and not in your prediction. Review your portfolio with your advisor. Not every time the market moves up or down 2%. So, to recap, the 5 biases that you need to watch out for are confirmation bias, loss aversion, herd mentality, recency bias, and overconfidence. In mutual funds, it's not timing the market. It's your behavior through time that builds wealth. So stay invested and stay disciplined. Let your SIP do all the magic for you. And the best way for you to stay disciplined is to join our Milestones2Wealth program. So, if you want to avoid these biases and make the most of your SIP, click on the description below and join our program today.